This is Brad Berry, Chief Investment Officer and Portfolio Manager with Dynamic Wealth Group. Welcome to this market and economic update. In this video, we'll discuss the latest jobs report, which has some investors and economists worried about the health of the overall economy. In times like these, it's important to maintain a broader perspective. Recent reports show mixed signals, signs that the job market is slowing and inflation remains stubborn, even as overall unemployment remains low and broader GDP trends stay positive. When economic data is unclear, it's helpful to focus less on headlines and instead on the foundations of the economy. Often, the first place to start is the financial health of consumers, since consumer spending drives over two-thirds of economic activity. Over the next few minutes, we'll provide some key perspectives that can help provide clarity on the economic environment. Let's start by looking at the job market, which has weakened in recent months. The latest jobs report provided further evidence that the labor market is slowing more than previously expected. Only 22,000 jobs were added in August, well below the 75,000 that economists had expected. The report also included substantial revisions to figures from previous months, with June's payroll numbers showing the economy lost 13,000 jobs that month, marking the first decline since 2020. While these figures are important, economists don't focus solely on headline payroll numbers, which can swing from month to month. Instead, they look at what's known as labor market slack, which measures whether people who are looking for work can find it. The unemployment rate sits at only 4.3%, which is a positive sign that many who would like to work are able to. Wage gains are still healthy, and there are still millions of job openings. In fact, there are approximately the same number of job openings as unemployed individuals across the country. So while some job numbers are weak, others are still healthy. This suggests the job market is weakening gradually rather than suddenly. Now, let's turn to consumer finances, which show resilience despite challenges. While the labor market is softening, consumer finances in general are showing signs of what is often called a two-speed economy, one in which financial situations vary based on factors like wealth and income. As you can see in this chart, credit card and auto loan delinquencies have increased over the past 2 years, due partly to increased borrowing among consumers and more recently higher interest rates. This rise has been concentrated among borrowers with lower credit scores, providing further evidence of a two-speed economy. However, the chart also shows that these delinquency rates have plateaued more recently and are still well below levels experienced during the housing bubble. This means that some households are stretched financially, but we are not yet at crisis levels seen in the past. Finally, it's important to look at the asset side of the consumer balance sheet. U.S. households' net worth remains near record levels today, as shown in this chart. Again, this reflects a two-speed economy, since households that have borrowed more may not be the same households benefiting from rising asset prices. Still, this wealth effect, where rising asset values support consumer spending, can help provide economic stability. This is one reason the many concerns of the past few years have not always directly translated into a weaker economy. This is also a reminder of what drives wealth creation over time, and why it is important to hold a portfolio tailored to your financial goals and risk tolerance. When the outlook is uncertain, and keep in mind, it is always uncertain, advisors and investors alike should focus on maintaining truly diversified portfolios and not trying to predict the future. There is virtually an endless amount of variables that can impact the economy and stock market. And yes, we touched on a few today, but it is by no means all-inclusive. As I have said many times, it is the bus you do not see coming that hits you. The future is unknown, my friends, and instead of trying to focus on predicting the future, our multidimensional asset allocation philosophy would instead say to focus on building a portfolio that includes multiple drivers of return, not just stocks and bonds, but also incorporating non-correlated strategies that can help to provide returns through differing approaches. Yes, we all hope for the best, but hope is not a plan. Preparation is key. Now, I hope you found these high level insights helpful. If you are a financial advisor and would like more information on our multidimensional approach towards asset management, feel free to download our white paper. You can click the link below or visit our website at dynamicwg.com or email us at info@dynamicwg.com. If you are an individual investor, we are happy to address any questions you may have and put you in touch with a qualified advisor if so desired. Until next time, take care, everyone, and make smart, logical, and fact based financial decisions.